All right, we're actually going to do a full statement of cash flows, and this is a very involved statement, so we're going to have to do quite a bit of work. But if you look at the end result here on the next page, let me scroll down here. What we're doing is all of the sections. So we've learned about, let's use a highlighter here. How about that? We've learned that we have the operating activities section. It's very involved. It's quite big. You can see that. We've got the investing activities and then financing activities. And then at the very end, we actually will reconcile all of this between all three of those activities and make sure our numbers agree. So it's perfect. There's a great check point here. We are given a lot of information here. We've got a balance sheet and an income statement, and then some additional information off to the side there. The balance sheet, it's really important that it's comparative, which means it shows the prior year and the current year. That's because we this time have to do all the math. We have to subtract the prior balance to the current balance to figure out the difference in the account. And we'll do that for all of these. We'll go over all of them. And then, of course, the income statement is given because we know we've got to look at that net income. We got to look for depreciation and gains and losses and stuff like that. So let's start with just going over that balance sheet that I mentioned, comparing the two numbers. So what we do for this is we look at the prior year and we compare it to the current year. So prior year is always going to be shown on the very far right, and then the current year will be here. So we are literally just going to do the math between these two to figure out the difference between them. So for example, cash, which is the first one listed there, the difference would be 43,500. So we just do the math there, subtract the prior year and the current year. And then what you have to do, this is the important part. So I know the math, but now I have to determine what did it do. So what I can see is that the prior year was 44,000 and this year is 87,000. So what I see is an increase. The amount went up. So, and actually instead of writing increase there, I'm going to use the word instead and we'll write increase. But what I can see is that the amount went up, right? For the next one, accounts receivable, it also went up. It goes from 51,000 to 65,000. So it increased by, it looks like 14,000, an increase. And let's do one more to show a decrease one. We'll go down to, this one actually decreased, 86,500. It decreases to 63,800. So that's a $22,700 decrease. Now what I'm going to do is I'm going to pause the video and I'm going to write these in for all of my current assets as well as my current liabilities. Okay, you might take a moment to pause the video real quick to jot those couple down that I just wrote. But I've got all of the current assets and current liabilities done, showing the increases and decreases. I'll use all of them except cash in the operating activities section of the statement of cash flows. Now, before I move on and go to that statement, I would like to go through the rest of the accounts on the balance sheet. Every account on this balance sheet, I'm going to be able to go through to see the difference, to figure out what it was that happened, what activity happened there. So, for example, equipment. I can see that equipment went from 115,000 to 124,000 this year. And there's a note at the bottom that says, and it's notes C and D, it says that we bought new equipment and we sold equipment. So I'm not going to scroll down to those, but you've got those printed on your page. So you'll look at those. Let's go through this math. So it's an important thing here is that we look at these numbers to understand the complete change that happened in this account. For the equipment, we know that our beginning balance was 115,000. And we know from note C that we bought more equipment. So we're adding new equipment. And then we also know from note D, so I'm going to put C here so that we can go back and look if needed. And we know from note C that we sold, sorry, just used the wrong word there, that we sold equipment. And the cost, which is the important thing that we need, cost was 48,600. So that's going to be a negative amount. So that came from letter D. And so if we add and subtract down, it equals 124,000, which is the correct end number. So we're good. So we kind of check that out. I'll do a little star there. We're good to go. We can take from beginning to end and we can reconcile all of that. That's important. Now the next line is actually accumulated depreciation. So we'll draw this one over here. So accumulated depreciation, it's a negative balance because it's a contra account. It's a credit balance account. So the beginning number here is negative 9,000. And what we know about this account is that we, of course, every year we add new or annual depreciation. And so that comes from the balance sheet, or I'm sorry, the income statement. And I can see from the income statement, it's right below here, I'm going to highlight it. It says depreciation expense was 58,600. So I'm going to write that in right here. And so 58,000, that's added, but because it's a negative amount, it's negative. So it's a credit. Credit is added to a credit, and they both look negative here. And the other thing that happened is that we sold equipment. Now that we don't know the amount, but that would actually be an addition into this account. And that's how we're going to end up with an end balance of 27,000 negative. So at this point, we need to solve for that. So we need to actually do some algebra, and I'll do that at the bottom of the page. So at the bottom of the page, I'm just going to show this algebra in the way that you guys are used to seeing it, and the way that most of our brains work, right? So we want to see it horizontally. So we've got a negative, there it is, negative 9,000. That's our beginning balance. We're adding to it a negative 58,600. That's the new depreciation for the year. And then now I'm going to add to that a positive number that I don't know yet. And that's going to get me to a total overall negative 27,000 as the end balance. So I just have to solve for this. So you know in algebra, we got to combine these two right here. These are what we call like terms. So that equals 67,600 negative. So I combine those two, and that's that. I still have my unknown here, my question mark. So now my equation looks like this. Now I'm solving for that. And of course, what you do here at this point is try to isolate that variable. So add that negative number to both sides. We're going to add it. It's not negative anymore. Sorry, we're adding the number so that it will cancel that out. And we end up that our question mark, which is the accumulated depreciation related to the sale, is 40,600. So I'm going to need that. So that's the accumulated depreciation for equipment sold. And I just highlighted that area up there blue, so I'll highlight that blue. 40,600 is my number. So let's move that up there. So we'll write that 40,600 up here and just know that that is related, that is related to the accumulated depreciation related to what we just sold. So I'll put C below. We'll have to do some more algebra in just a second, but let's go through more of our accounts. So I think we're to the point of notes payable. That one we need to look at. Everything else above that we've gone through. Notes payable, it went down by 30,000. And if you read note A, we read that we paid off a loan. So I'm going to put I'm going to say CA. So that can be there. And there we go. So that was just letter A just explains that we paid it off. We used cash. We retired it completely. Okay, for equity, which is the next one, when we go down the list here. So common stock is another one that needs to be figured out. And I can see that it goes from 160 to 220. So it actually increased by 60,000. That's an increase. So that means we must have sold some stock, right? And so I can see that in letter, actually there is no information on that one, but obviously when you sell stock, that's the only thing that can happen. So we must have sold stock. sold, stock sold or issued, right? So we'll write that in there ourselves. Okay. The last one though, retained earnings, that one we actually have to do some work on that. So let's draw this one off to the side as well. So retained earnings, we know is an account that uses multiple things in it. So we have a beginning balance of retained earnings of $24,100. We know what goes into retained earnings would be net income, because that's the revenue and expenses. And we also know that dividends comes out of retained earnings. So if we had a retained earnings statement, which would be really helpful here, we could just go to that. But we don't have that, so we'll have to actually calculate. So what we know is net income. We know that's $99,510. Of course, that comes from the balance or the income statement. So that gets added. And we don't know dividends, but we do know the ending balance of retained earnings, which is $33,300. So what we need to do right now is solve for that unknown. So again, we'll do that below. Now what's great about this one too is that they do tell us in letter B that it is paid with cash. So these are paid with cash. So the amount that we're about to calculate will be a cash amount. We don't have to worry about if it was declared or paid. So there we go. So because we have to solve, we're going to write this out in a little algebra fashion. So I've got my beginning balance plus net income minus dividends equals the ending balance. So I'm just writing out what I wrote above, but I'm writing it out horizontally so that I can do my math a little easier. So I combine these terms, I add them up, and I basically find that it equals that amount. And then I'll be able to, once I write this out here, now I'll be able to take that amount, $123,610, and I need to cancel it out. So I need to subtract it from this side. So if I'm going to cancel it out there, when I subtract it, I need to then also subtract from the other side, right? Whatever you do to one side, you got to do to the other. So in the end, what I find is I end up with a negative $90,310. So, and I better show that as negative this way. It's easier to see. So I'll show it as negative. So my question mark, which is also a negative number, that means dividends were $90,310, and I know they were paid in cash. So I can write down $90,310 cash dividend. So I need that when I go to do the financing section. So now we've got that information there. I'll put C below so we know. And there's where we solved that. So now I've gone through all of the balance sheet and figured out everything that I need for certain parts and pieces, but I still need to look at that income statement. I did highlight depreciation expense. That's an important thing because I know I'm going to have to add it back. And also look for any gains or sales on equipment or any long-term assets. So I found that. I'm going to need that information. And of course, I need that net income number. So, and that's all I need from here. There are some notes reminding me that a lot of my current assets are related to things on the income statement. So that's an important piece. That will be how it is in this book. You won't see any tricks there. But that's it. So at this point, we've gone through this entire page and done a ton of work, right? And now we're ready to do the statement. Now we work on all of those accounts in current assets and current liabilities. So the first one that we had was accounts receivable, and that was an increase. So I'm just going to abbreviate here. So remember, with that increase in a current asset, that actually means we need to subtract it. So that $14,000 increase will be subtracted with all of these adjustments we're doing. The next one's inventory, and it decreased. When inventory decreases because it's a current asset, it actually means we need to add it. So $22,700 will be added. And the same thing for the decrease in prepaid expenses. Okay, so you see I've got that prepaid expense written in now. I'm going to focus on the current liabilities. We had 3 of them: accounts payable, wages payable, and income taxes payable. All 3 of those were decreases. So when they decrease, that actually will be a negative amount. So I will write those in and you'll see those pop through. I'm having a little bit of trouble with my iPad, so you'll just see those change in just a second. The statement is again divided into those four major sections, the bottom being the reconciliation, and then technically there's a portion at the bottom that should be for non-cash activities, but we don't have any. Things like exchanging assets for a note or exchanging an asset for another asset or any other non-cash transaction. So at this point, now I can just go through and complete this in the way that I know. So for example, operating activities. I know that in this section, I'm going to put net income and then I'm going to do a whole bunch of adjustments. And then I'll end up with my net cash provided or used in operating. So if we zoom in here, because of course that's what we want to do, and I'm going to do my best not to go back and forth to that prior page because it does slow down my screen and my recording. So you might need to flip back to look at these numbers, but I have highlighted them and I know where they're at. So net income comes from the income statement, and I know that is an accrual-based number. So that number is actually not going to help me. What I need it to be a cash-based number, which is what we're going to show down here on this line here. So to do that, we know we need to do adjustments. So our adjustments include always adding the depreciation expense, any amortization, depletion, any of that, which we don't have. But for this one, I do have depreciation. So it's $58,600. I also have a gain on a sale of an asset. I think it was equipment. And that was $2,000. And see, here's the deal. A gain, because I want to cancel it out, a gain means I'm going to subtract it. That way I cancel it out, right? So I add depreciation, and I know I like to show these in black. So I add depreciation expense, and I will subtract the gain. Okay, so now all we have to do is total out all of those adjustments, including the ones we just entered, the current liabilities, the changes to the current assets, and then these two that we had for depreciation and the gain. We've got to take all of those, add and subtract them from net income, and we'll get a total amount. And that total amount, just mathematically, is $151,410. That number represents, since it's positive, it represents net cash provided by operating activities. So we were able to take that accrual-based number, make those adjustments, and change it into a cash-based number. And that is so important for our problem. So that first one that we just entered, let me label that. Let's call that off to the side. Let me put operating. And now that we have the operating section done, I like to go back to that balance sheet that we were looking at earlier and cross off the things that we already looked at, because pretty much we're going to go through everything on this balance sheet. So let's go ahead and get a highlighter here and let's highlight through the accounts that we just changed. So let me change that right. Okay, so let's grab a highlighter. We'll do this color. Okay, so we know we just used accounts receivable. We used the inventory and the prepaid expenses. So that represents all of those current assets. We did not use cash yet. And we did do all the current liabilities, accounts payable, wages payable, income taxes payable. And then we had just a couple of things that we use from the income statement. We don't use everything in the income statement, but we did take care of that depreciation expense, the gain, and then of course we use net income. So we've used everything that we're supposed to use for that operating section, right? All right, so let's move on to the investing. So again, we're going to use the accounts that we've already dissected. We've already done all the math on. But for investing, it's long-term assets. So things like equipment, and then of course that accumulated depreciation account, we had to use that as well so that we could find out the amount used for the actual sale of the asset. So we know that. So basically what we have is we have the sale of the asset, which, I haven't done that work yet. I got to redo that, or I got to do that. I guess all we have right now is the new price of the new asset. Now the sale of the first asset. So let's go ahead and do that. The sale of, I think it was a piece of equipment, if I remember correctly. That's letter D. And what we know for that one is, okay, we'll do that work right up here. So when we sold equipment, what we know about that is that we have a book value of that equipment, but the book value of the equipment we don't have yet. So how do we get book value? We take the cost and we subtract accumulated depreciation. So for this one, the cost was $57,600 and the accumulated depreciation is $40,600. So pretty easy math there. Oh, nope, I'm sorry. I've got the wrong numbers. I knew that was wrong because I know the answer. So it's the cost of the asset is $48,600. There it is. Let's highlight those. Let's change those to, let's do red. So we know that the cost of the asset is $48,600. That was given. That's this number here. And we calculated right here the accumulated depreciation of the asset to be $40,600. Wow, it's been a long day. I've actually had a lot of trouble doing these videos. So I have recorded this several times, but had trouble with the savings. So anyway, when we take the cost, which was given, the accumulated depreciation, which we calculated, we get a difference of $8,000, exactly $8,000. We call that book value. Book value of $8,000. And then to find the actual sale of the asset, we would add any kind of gain, or if it was a loss, we would subtract any kind of loss. In this case, when you read this letter D, we find out that there's an actual gain. So let's add 2,000 to that. And again, that comes from letter D. So let me go ahead and I'll do my best to move this around without moving too much. Okay, so that gain is stated right here, letter D. So try to make that a little arrow. All right, so that comes from D. Okay, so when you add 8,000 and 2,000, that tells us the actual amount of the sale, the actual cash received from sale. That's the number we need, right? So I'm going to go ahead and highlight that number. So what I know for long-term assets is that I have a new asset that I bought for $50,600 and I sold an asset for $10,000. So we're going to go ahead and record those again in the investing section. So we'll scroll down here and write those in. And we're just going to make those red. So the order doesn't matter, but typically what you'll see from the answer keys, or what I see, I should say, from the answer keys is that they like to do the incoming money first. So cash received from sale of asset, and that's 10,000. And then I'd like you to put a note off to the side of that. So when we do a sale, what you have to do is you have to take book value, which in this case we had to calculate, and we either add the gain or subtract a loss. That's how we get the actual sale amount. And then we have cash paid for, and we'll say new equipment. I think we're supposed to put asset, but that's okay. You'll get it. So new equipment, 57,600. Now cash paid means that would be a negative number, right? So that's money out. And then of course that 10,000 is money in. So when I look at both of these together, the only two transactions I have, I'll add and subtract them. I'm going to actually end up with a negative amount. I'm going to end up with let me put that in red, 47,600 negative. Now, when you have a negative number, what that means is it means net cash used by operating investing activities. And then I will just highlight that off to the side by using, I think I used an orange color, right? So we're going to make that really big and we're going to put, nope, that didn't work. We'll write investing there. That way we've got those numbers bright. Here we go, investing. So I've got operating and investing done so far. Let's move on to financing. So we move up to the information page again for this one. Financing is anything long-term liabilities and equity type stuff. So a couple quick ones. The first one is that we had notes payable, and remember that one we paid on our loan. So we had that $30,000 payment. That was letter A, and they said, hey, we basically retired a loan. So we're going to write that one in. Another easy one that we had is that that we issued, which means sold common stock, and we had $60,000 of incoming money for that, so that one we'll write in. And the one that we had to spend a little bit of time on is the dividends. So remember, we did some calculations on that. We did it off to the side here, but we found out that dividends, that we had $90,310 in dividends. So all of those need to be recorded as financing activities. So we'll move down here and record those. And I'll zoom in just a little bit here. Okay, so again, we like to do the cash in first. So let's do that. Cash received from issuance of stock. And that is a positive $60,000. And then we just had cash paid we say retire because we paid it off basically. So retire notes payable. That was 60,000, no, 30,000, sorry, negative 30,000. And then the last one, it's that big number, it was 90,310. That's how much we paid in dividends. So that one, negative, of course, that's cash paid for dividends. Now remember, if dividends are declared, we don't do anything. But if they're paid, that's when we enter them on the sheet. So if we add and subtract all of these are my investing activities. I get a negative 310, and that's a negative number. I've been showing the negatives with black around them, so I'll do that here as well. Now this one, let's call it financing off to the side here. This is our third one, and this is negative, so it's again net cash used from financing or by financing activities. Okay, all three of those are done, and so if I go back here to the information page, I can see I've pretty much gone through, I definitely have gone through all of my accounts. I did miss highlighting one of them. Retained earnings should be highlighted, so I'll highlight that there, yep. So we've gone through all of our accounts, the balance sheet. The only one we haven't looked at is cash, and that's because cash is like the final thing. So for cash, it's the reconciliation. I'm going to take the current balance, which is $87,500, and I'm sorry if previously you might have saw 65,000 in that spot. I grabbed the wrong number, but that's the right number, so I've highlighted it in yellow. Let me go ahead and zoom in so you guys can all see that. So cash, beginning and ending balances are here. Okay, so beginning balance would be last year's ending number, so that's my beginning number. And of course, this 87,000 is my ending number. Now, this is where we can find out if we're right or not. So when we go back to the balance or to the statement of cash flow, if I take these amounts and enter them into this bottom portion, which is like a reconciliation. So this bottom part right here is where we basically reconcile. And if it works out perfectly, then we're good. So that's our goal right now. And so what we want to see is that the end, so this is the prior year end, so there's that balance, and then of course the current year end. So I'm going to put those numbers in. What was it? 87,500 is the balance right now. 44,000 was the balance. So the difference between these two, which we already know, we wrote down, it's 43,500. Now we wrote that down. Let me show you where that is, because I want to make sure you remember we already calculated that. So that was at the very top of this balance sheet. We already calculated the difference between beginning and ending cash is 43,500. So when I come back down here to the statement of cash flows, what I want to see is if I take all of these changes, so operating, that's the total for operating, that's the total for investing, and that's the total for financing. If I take all three of those, and I'm going to change that to orange because I think I was using orange for that. If I take all three of these amounts, add and subtract them, so 151,410, that's positive, and then I'm going to add, but it's actually negative, 47,600. Then I'll add that last one, 60,310, but again, that's negative. So basically I take 151 and I subtract all of these. That's operating, investing, and financing. What I'm going to find is the difference should be 43,500. That's how I know if I'm right or not. If that number matches up, if that's the correct amount, then I'm good and I did everything correct. If it's not, then I have to go back and take a look. And I'm going to tell you, this is my best advice for you. If your reconciliation is not working out, if you do not have this perfect end result, if your numbers don't jive, the beginning and ending numbers, again, these came from the balance sheet. So let me write that down. These numbers come from the balance sheet. That's where we get these numbers. If your numbers don't match up, my best piece of advice is to go through the operating section. That is the hardest part, right? That one had a lot of increases, decreases, or could be a lot of mistakes in there. We could have done positives and negatives incorrectly. We could have done our math incorrectly. Some errors could have happened in there. Check that spot first. If you find an error, fix it, and it works out, then you're good to go. The next thing would be check your investing and financing. And the way to check those, obviously you'll check the numbers, but another way to check those is make sure that you go back to that balance sheet. And like I did in purple here, you have to make sure that you have gone through every single one of these accounts. All of these accounts have been taken care of. So obviously the total accounts we don't have to worry about, right? So we didn't do anything with totals, but everything else, we made sure that we did something with it. We calculated and then we made sure we took that amount and we put it somewhere. We put it in the right section. So those are my two best piece of advice. So hopefully you enjoyed this one. Doing a full statement of cash flows is great because then you get to that bottom portion and you can see if you're right to make sure everything that you did is correct. So, all right, that's it for now.